Hi everyone, welcome back to Be Rich. Keshav has always been asking me a lot of questions about balance sheets. So I thought we'll continue our conversation today on this balance sheet. He's always been asking me, how is it decided if something is an asset or if something is a liability? Keshav asked me. Then he asked me, how do we reach a so-called book value? How do we get to all this? Why is all this so important? This balance sheet is what Keshav was asking me. Right, Keshav?
Yeah, sir. There are so many terms in balance sheet, but on the first video we have covered the basic terms, sir. If anyone asks me what is balance sheet, I can tell them it contains of assets, liabilities, and shareholders' equity. I can say that, sir. I can give a little brief about that, but not
Very
full
good.
interior.
I'm happy with that. That's all I wanted you to, from the first video, all I wanted you to understand was to be comfortable with this whole balance sheet business.
Yes, thank you.
That it's not some secret rocket science that you don't have to be a CA auditor to understand it.
Okay.
That is very easy to understand. It's very logical. In balance sheet, there are two main sections. Okay, one is your asset side, the other is your liability side. For the sake of discussion, we'll use our Keshav medical store.
Okay, sir.
Okay, when you start your company, we said either you can take loan
Or you can invest your own money.
own money. That's your share capital. Correct?
Yeah, sir.
So let's say we take 100 rupees and we put it inside and we start Keshav
Medical store.
And you also realize once you start that, Keshav medical store needs more funding. So you borrowed another 100 rupees at 10% interest.
Okay, sir.
And you put also, so 200 rupees you put. For the 100 share capital which you put, you have issued 10 shares. Each share has a face value of 10 rupees, that means.
Yeah, sir.
Okay, so 100. 10 into
sir.
10, 100.
Yeah, sir.
So 10 shares. Okay, so this is how you started. In the liability side, one way money comes into this is, into the business is where you invest, where you put in capital and borrow money and you have invested. The other way is through sales. Same way, what are the ways that money goes out of the business? As a business, what are the ways that money can go out?
The products we buy or
Correct, inventory.
something
Raw
that
materials.
we invest on other things.
One is in buying machinery and all that.
Yeah, sir.
The other is, those are capital expenses, one-time investments. Other investments will be, other expenses will be like what? You'll be paying rent,
Yeah, sir.
salaries.
Rent, salaries.
You'll have to pay vendors, raw material for what are you manufacturing.
Yeah,
Correct?
Sir. Yeah, sir.
GST, right?
Ah.
All these are clubbed together and they're called operational expenses.
Okay, sir.
One-time capital expenses, you forget, those are there. Those are one-time. But these are operational expenses. That means they keep on coming.
Coming again and again. Okay, sir.
Understand? Operational expenses there. Then what other thing will be there? You borrowed money.
Yeah, sir. I have to
So
pay
you
interest.
have to pay interest to the
Yeah,
lenders. So that is another expense. So another way, another person who gets, the way money goes out is you have to pay interest to the lenders. Then who else will be paid? Who else as a Keshav medical company, what else will you have to pay money?
Where else? I issued share, so I have to pay the
Dividend,
shareholders.
shareholders. Shareholders also get. So one is operational expenses.
Yeah, sir.
The other is shareholders. Then you have to pay the lenders. One more, fourth person is who? The most important person.
Government.
Correct.
Okay. Okay, sir.
You have to pay Nirmala Sitaraman.
Tax. Okay, sir. Tax for the government. Okay, sir.
As Anand says, Ammayar.
Yeah, sir.
So you have to pay. Government of India has to be paid. So government taxes.
So now you said we have to pay to the government tax. In the first video, we learned something that if we pay interest to someone, we can deduct from the interest from the tax. So
we are talking about why is it cheaper to borrow money compared to
Then paying
putting
tax.
capital investment.
Okay.
Because the interest which you pay to the borrowed money, the capital money, can be written off as tax.
Okay.
You get a tax break. Forget that. That is one portion of it.
Okay,
But
sir.
I'm trying to even get it down to simple.
Okay,
Before
okay,
we get into, there's two sections of the balance sheet. Balance sheet talks about money coming in and money going out
Okay.
in a business.
Okay, sir.
What does the balance sheet tell you? Where money is coming in from,
where
its money is going.
Okay, sir.
Where can money come in for a business? It can come in through investment,
Yeah,
which
sir.
is share capital, loan and taken and invested into the business, and sales. When you sell something, money comes.
Yeah,
When Keshav is selling medicine, all that money comes into the business. Where does money leave the business? operational expenses, which is GST, salary, overheads, rents, vendors, all the raw material. Then shareholders you have to pay.
Yeah, sir.
Lenders. Then lenders have to be paid. Then government taxes.
Okay, sir.
Income tax you have to pay. These are all the way the money leaves.
Okay, sir.
Correct? So let's say, for example, that you have done 300 rupees worth of sales.
Okay, sir.
Okay? This year, we're doing the balance sheet. 300 rupees worth of sales you've done.
Okay, sir.
And this year's operational expenses, you calculate salary, everything, rent, you say it's 100 rupees. Now what is left?
200 rupees.
Correct. 200 rupees of profit is left.
Yeah, sir.
Correct? After all operational expenses, salary, rent, everything.
Everything.
Yeah, you haven't paid taxes. Only GST and all that has been paid.
Yeah, sir.
GST is operational expense. Okay, that has been removed. You have 200 rupees profit.
Okay, sir.
That profit is what is called as EBIT. Remember we spoke about that? Earnings
before interest and tax.
Correct.
Okay, sir.
You understand now?
Yeah, sir. Yeah, sir.
Now you know what. So whenever it says the company's EBIT, you know what it is.
Yeah, sir.
It is nothing but the sales, the revenue
Before
through
interest
sales
and tax.
which has come, and you've removed all the operational expenses.
Yeah, sir.
What is left is the profit.
Profit.
That is only called the EBIT, or profit before interest or tax.
Okay, sir.
Okay.
Okay, sir.
Who's the next person who gets paid? First is option expressions has to be paid. Salaries, everybody has to be paid first.
Okay,
Who's the second most important person who gets paid? By case of medicals.
That is the shareholders.
Out of the four.
Lenders.
Correct. You have to pay the loan. Correct. So you borrowed 100 rupees, 10%. So
10 rupees.
10 rupees interest you have to pay.
Okay, sir.
So that you also remove. That is 10 rupees. So 200 minus 10?
190.
190. Correct. Okay. 190. 190 is what's left.
Okay, sir.
So out of that EBIT, what is removed? I is removed. So now it's earnings before tax.
Yes, sir.
So earnings before tax is
90.
190
is remaining.
Correct. 190 is remaining.
Yeah, sir.
So who gets paid next?
Tax.
Government. Correct. So let's say it's calculated this way, that way, and government tax has come to 90 rupees.
Okay, sir.
Income tax. Out of 190, 90 rupees goes off as government tax. Now what is left?
Then I have a profit of 100 rupees.
Correct. 100 rupees is left. This is the profit. Okay. Now, the question which you'll be wondering is, if 100 rupees profit is left, lender is paid, government tax is paid, operational expense is paid, can you take that 100 rupees and give it to the investors, dividend?
Okay.
Do you fully pay that to the dividend? Why don't companies, like you hear Apple having $5 trillion, they made profit. Why aren't they, like you hear ITC is made 10,000 crore profit or whatever, X amount profit, HDFC Bank, and you're a shareholder, you think you divide. You know the total number of shares. They're saying I should get dividend. No, sir. They made so much profit.
Yeah, sir.
Everything is gone. Tax paid, lender paid, government paid. All the remaining money is
paid.
Is free money now. Why aren't you giving the investor that money?
Sir, you already said if the company which doesn't pay dividend, or else they invest on somewhere else to start another company.
Correct.
In somewhere else. Okay.
That's where you should understand.
Okay, sir.
When you say something is profit, that doesn't mean if you go check in Keshav's bank account, Keshav Medical Shop's bank account, there'll be 100 rupees sitting there. That 100 rupees could be stock, it could be in XYZ places.
Okay.
You might actually have minus money in your bank account.
Okay. Negative. Okay.
This is only on paper. Correct?
Understood, sir.
So when you take everything into account, this is on paper. So it doesn't mean there is actually 100 rupees in the
bank account.
And like you rightly said, that doesn't mean you can take that money immediately and give it to the investor.
I can expand my business.
You will want to expand your business. You will have to pay something. Like we spoke about contingency liability. You might have to first pay the loan. That 100 rupee loan, you only paid interest. You still have to close the loan, right?
I may use that to close my loan.
Correct.
Okay.
So, Keshav, being the owner, will decide, okay, out of the 100 rupees, I'll give 10% as dividend.
Okay.
So 10% out of 100 is how much?
10 rupees.
10 rupees. So 10 rupees will be paid as dividend.
Okay.
Now Keshav is the owner. In a company, the owner is who? The board of directors. The board of directors, they sit together and they decide. They'll have a meeting.
Okay.
That's what the annual general body meeting is. You'll always hear AGM. What the hell is this AGM?
Yeah, sir.
Yeah. These guys are the guys who are running the company. Right? They'll get together. They'll decide, okay. They look at all the reports and everything which is given to them. from the management and everything. They'll look and say, okay, we decide so much money profit is there. We will give dividend of X amount.
Okay.
Okay.
Okay, sir.
So they decide, and you take 10 rupees and you're given. So 90 rupees is left. Now that 90 rupees, what happens to that? Where does it go? We spoke about this. Where does it sit in the company's books, in the balance sheet?
Earnings yield, sir.
Reserves.
Reserves and surplus. Okay, sir.
Okay, it goes sits there.
Okay.
But on the balance sheet, reserves and surplus, though it is positive, it sits on the liability. Why? It is a liability.
Because I didn't close my loan. That's why.
That's correct. It's correct thought process you have. One is a loan, and you have to first pay back keshav, no? You put 100 rupees to start the business.
Oh, okay.
The investors put the money to start the business, no?
Okay. I have
they
to pay
been
them
paid
back.
No. So all this money is actually money that needs to be paid to the investors.
Okay. So that sits on the liability.
That's why it's a liability.
Okay.
Though it is in the company, it is a liability because the company doesn't actually own it. It is actually owned by the investors.
Okay.
You understood?
Understood, sir.
Right. So when you calculate the net worth of a company, you take the share capital. Right? What is share capital? Amount
The
of
seed
money you put.
Okay, sir.
Plus you add the reserves.
Okay.
You add the share capital and you add the reserves together. That total is called the net worth.
Okay.
You with me?
Yeah, sir.
Net worth is nothing but the share capital
and the reserves.
The amount of money you put into the business to start the business, plus all the reserves which you have left over, you add it together, it becomes a net worth.
Okay.
That net worth, you take it and you divide it by the number of shares, gives you
That
book
flows
value.
in the market.
That
Okay.
gives you book value.
Okay. So it seems like.
Wait, let's come to case of medical store.
Okay, sir.
So you put 100 rupees to start business.
Okay, sir.
Correct? You put 90, reserves is left.
Yeah, sir, that is the doubt. It stays on liability, but it is on reserves and surplus only.
Yes.
But it is a liability.
In the books, it's written
In the
as
books,
liability.
is a liability.
It's like you take my money, 100 rupees you borrow from me. It's in your wallet. 100 rupees is then in your wallet.
But I
it's
have
not
to
your
pay
money.
back. Okay, understood, sir.
You borrowed it from me.
Now understood, sir. Okay.
Though it is sitting with you, whose money is it?
Your money.
You should never forget that.
Okay.
The biggest problem for all businessmen is all businessmen in India, big and small, including Anil Ambani to Vijay Mallya, they all forget.
Whose money they have.
Yes.
Okay.
Because if you forget that you borrow that 100 rupees from me and it's in your wallet, that money is actually my money and you're holding it. For me, you'll forget that it is
Your money.
correct.
Okay.
Credit card, same problem. Credit card is swiping,
Yeah, sir.
thinking it's your money. It's not your money.
It's the bank's.
Bank's money. He's giving it to you.
Just I'm spending.
So you owe it to him.
it.
You forget that. And you think you have a limit of 10 lakh credit card, thinking you have 3 lakhs. It's not yours, boss.
Understood, sir.
Understood?
Then calculating that we
So,
have a net
yes.
worth of 190.
Correct. 190 divided by 10.
10.
So book
Okay.
value is what? 190 divided by 10.
19.
Correct. 19. That is the book value.
Okay.
Now, when you say a company is trading above book value and below book value, what does that mean?
Sir, you already said the book value for a financial.
That is the actual price of the share.
Okay.
So you issue the share at face value of 10 rupees a share. Now with the reserves and everything, it's gone up to 19 rupees.
Okay.
So the book value now instead of 10 rupees is
it
actually
moved to 19 rupees. Okay.
Now when you're saying it's trading above book value, that means it's trading above 19 rupees.
19.
If
Okay.
it's trading below, means it's below 19 rupees, it's trading below book value. Book value is set internally. It's got nothing to do with outside, not anything with the stock market. Book value is decided by amount of business you do and everything. It's like your blood group. You know, you can't change it. The external market is what sets a market share price. That is external.
But the
So
book
when you
value.
say, book value is always constant.
Okay.
Year on year, the book value will increase or decrease depending on. But the share price moves up and down rapidly every day, every minute.
Okay.
So when you say something is trading below book value, that means
It's trading
it's-
below 19.
below 19. That means whatever price the market is giving,
It's
it's less than actual value of the company.
Okay.
So that's why they say it's good to buy it.
It's a
When it's
buying
trading
opportunity.
below book. That means, let's say you buy all the shares and you liquidate the company, you make a profit.
Okay.
Let's say the book value is 19 and the share is being sold for 5 rupees.
Okay.
So you buy all Keshav medical shares. 10 shares are there. You buy all 10 shares for 50 rupees, right? And
Okay.
you liquidate the company. You still have money left because it's trading below book value. You close all the loans and everything, you'll have cash left. You make a profit. You minus say 50 rupees from that, you have a profit.
Yeah, sir.
Theoretically, this is all theoretical. Same way, if it's trading above book value, that means it's overvalued the company.
Okay, then we have to wait for
That's
the
the way
company
to evaluate. One of the ways you evaluate is by seeing the book value. This is one of the metrics. It's not it's not like the metric. It's one of the ways.
Okay.
You understand?
Understood,
How
sir.
we come to book value now?
Understood, sir.
You understood why a balance sheet we look at. It tells you where the money comes in and where the money is going out in a business. So as an investor, you can see where is all the money coming in for this guy, this business.
Okay.
Where is all the money going out? The money goes out in what places? It goes out in operational expenses, shareholders,
Lenders,
tax,
government
and
tax.
government taxes. These are the four main.
Okay, sir.
Where are the two main places money comes in from? Through share capital, loans to do the business, and sales.
Okay, sir. Understood, sir.
Understood?
Completely, sir.
So this is all a balance sheet is. So all you do is the first person who gets paid is the operational expenses are first paid by the company.
Yeah, sir.
Second thing that's paid is the lenders get paid.
Okay, sir.
The third person who gets paid is all the government taxes are paid. Fourth is the investors,
The shareholders. Okay.
shareholders.
Okay, sir.
That the board of directors will decide how much dividend to pay out this year, and they will declare so much percentage of dividend profits we're giving.
It's their wish.
Correct.
Okay, sir. Understood, sir.
That's why in a lot of companies you'll hear the news. There are, some activist investors who buy a lot of shares and get a voting member, get a voice, and they'll tell the board of directors, no, you should pay us more dividend.
Okay.
Very famously, Anand sir will tell you many stories like this. Where one guy will go buy many shares and then demand the company does this and does. If they don't do, they can go to court and say, we are investors. I am so much invested. I have so much percentage of investment share, and the board of directors are not listening to me. The CEO is not listening to me, and get the guy thrown out also. We hear about all this in the news. It's all about this.
Okay.
End of the day, the amount of money that company has, and we want to grab it.
Understood, sir.
Understood?
Yes, sir.
Chalo. Next video, we'll try and talk about profit and loss. And is it in the balance sheet or not in the balance sheet? That question you asked me.
Yes, sir.
I'll answer it and we'll discuss in greater detail, and hopefully you'll be able to understand it.
Yes, sir.
Anyway, thank you for joining us today on Be Rich. I hope you enjoyed this video. If you did like this video, please do like and subscribe to our channel and turn on the bell notification so you'll be notified every time Keshav comes out with a new video. Thank you again for joining us on Be Rich.
Thank you.
I am in Tokyo on work on the 5th of August 2023. I have a lot of following in Japan, Tokyo. Those who want to meet me in Tokyo on 5th August, kindly drop me an email on the address given below or contact us on WhatsApp there. My team would get in touch with you and facilitate the meeting. Once again, I thank you for your support for Be Rich. It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.